Hi guys, it's Chima here again. Today I'm going to be continuing from where I stopped in the live video. I try as much as possible to make these videos short and straight to the point. And in the last video I talked about the market manipulation, and this is going to be the second market manipulation too. And I'm going to go into live examples, and I'm going to be talking with the charts. So let's assume you didn't watch the last video. I think you should go back and watch it because this won't make any sense to you if you didn't. Now, if you watched the last video, you remember what we talked about, and they have to come back down to grab liquidity, clearing all these orders. You have long orders here, they clear all the stops, and they also go down to clear the pending orders for sell. Okay, so all of these are liquidity levels or the liquidity pool, and they have to come down to grab that. So the market makers, all the dealers have to clear that. Okay, so there's something I didn't say in the past video, and it's the fact that these guys go out every day looking at the price, how the market is structured, and how they can go against it. Okay, they actually know everything that we all know, the breakout strategy and everything. So it's nothing new. And before any news release comes out, they already know these news releases. So they're not actually going to say, oh, non-farm payroll. I actually talked about this in the first video. So they are very aware of everything that's going on. So they all know this. And so if you are buying without the information that these guys have, you're actually ruining yourself. You're going to lose a lot of money in your account. And a lot of us have actually lost money. So you're actually looking to buy here, and they clear that. They take you out. They take your stops. They trigger your stops, and they actually take it a little bit further to the downside and trigger a lot of pending orders for sell. Okay, and after which they push the market upward. They push price upwards. So, and I told you in the past video that most times they have orders that they have to put in the market. So they're not going to be able to put those orders when a lot of traders are doing the opposite. So these orders are put in the market by little chunks. I talked about all of these in the previous video. So they have to clear you. They have to clear all of your orders in order to take their own orders. That's one part of it. And then the other part is that they have to take your money. Okay, that being said, when you understand this, you will be trading at levels such as this. You'd be trading, your entries would be somewhere here. I'll go ahead to market now. With very little drawdown for a buy, you'd be trading around here when you're able to identify what they're doing. So if you have identified that they actually pushed the price all the way down and grabbed all that liquidity and pushed it back up, it means that they have an underwater position, which they have to come back down to mitigate on. I talked about all that. And now they mitigate on that position and push the price upward. So you want to enter on the mitigation, okay, on the levels, price levels where they mitigate. And here's another one. So you want to enter on this level right here. Okay, I'm going to do an arrow. These are the levels that you want to trade off of. For your sell and for your buy, you want to buy at this level with very minimal drawdown, because as soon as they have mitigated on their underwater position that they had to use to grab liquidity, there's no reason for them to push the price to the upside anymore. So they're just going to rush it all the way down, So I know the question that you're asking, how can we apply this? Okay, I'm going to go straight away to the charts, and I'm going to put in the rules so you can see how this works. So let's go straight to the charts, to my charts right here. So this is the euro dollar, the euro dollar, and you can actually see on my screen I have a lot of lines, and I'm going to go straight away to explain what these lines are right after I have I've corrected this. So basically what these lines are the support levels. You all know that. Support and resistance levels, what you call support and resistance levels. So because You know, as a retail trader, you want to trade and sell off a strong resistance level, and you want to buy off a strong support level, right? That's what everybody's taught. That's what everyone knows. So, but what this video or this lesson or this class is all about is letting you know that you're not supposed to trade on these levels. You're supposed to watch these levels. You actually want to wait for the blueprint of these banks or the dealers to see what they're doing, and you want to trade after you know what they have done. You're going to see the blueprints, and I'm going to show you how to see these blueprints. And it starts with your regular support and resistance, your regular areas of support and resistance. Okay, I'm actually online today, but my charts are not misbehaving. I found a way to really tweak this and not make my chart move, skip all back and forth when I'm talking. So I really appreciate my guys who showed me this and said, okay, you just press that button and it's going to behave. And yeah, so going back to what I was saying, I said you have a strong level here of resistance right here. I'm using the week, okay? The week, that's what I'm using right here. And you see price went all the way down, respected the same level and came down. Yes, if you sold here, because if you had sold here, you would have made profits, okay? You would have made profits. And I really want to start talking from here. Look at what the market did. Someone else would have said, okay, I'm going to start selling from here at this long candle right here. But something happens right here. You look at this weak level right here, it got broken, it got bridged. It got bridged. You can see, look at the long area. I'm going to try to calculate how much pips covered from that wick to the upside. It was more like 20 pips. Okay? A lot of folks are going to sell here and have their stops just like 5, 10 pips above, or unless you're the type of guy who trades off on a sell here and then you put your stops here. It's not the best though. You really want to risk, you want to put tight stops. But the thing is, a lot of folks are going to put tight stops and they get taken out. And some other folks are going to put in pending orders, buy pending orders, that believing that the price will keep going up, or once it breaks a strong support or resistance level. In this case, it's a resistance level. And it did break it. And you see the week right here. This is the 4-hour chart. So our question and what we're trying to say is we're looking for the exact candle that was responsible for breaking that support. Okay? If you look at the 4-hour chart, you'll say, you're going to be giving me this candle. Let me zoom in a little bit so you can see it. If you were looking at the 4-hour chart, you would be looking at this particular candle right here, this candle, this one, the very long candle, institutional candle on the 4-hour chart. The reason why you see very long candles like this on the 4-hour chart, it means that it happened real fast. The move happened very fast and it cleared all that liquidity. So the first rule you want to take note of, you can write this down right now, you can write it down, is look for the candle, the exact candle that was responsible for clearing out liquidity or to clear out that support or resistance level. And remember, the level we're talking about here is what I marked in red. I'm going to clear any extra lines so you don't get confused. The level I'm talking about is here, right here. That's the resistance level I'm talking about. So which candle was responsible for clearing all of this? This candle was just within this level. Okay, I'm talking from here all the way up. Okay, so in order for us to get that, we have to go to the lower time frame. We'll go to the 1-hour charts to see if we can find it. We still can't find it. Look, it happened so fast, so quick. Go to the 30-minute chart. If we can find it, we still can't find it. That shows you that this was a very quick move. We want to get that candle. And I go to the 15-minute chart to see if I can locate that candle that was responsible. I guess I'm lost now. Okay, the 15-minute time frame to see the chart, to see the candle that was responsible for breaking that level. Can we find it? Yes, we can. Now you can see on the 15, look at the long candle right here. And then we saw it, and it closed at this level. This was the high, and it closed here. Now we have what? We have another candle right here that moved all the way up and broke this level and went all the way into the extra line that I drew. And this right here is the candle. So you see, I had to draw another line on the open of that candle. Because that's the candle that was responsible for tearing up all that liquidity and grabbing and closing all the orders from retail traders. Okay, because if you were selling and you had your stops here, you would have been taking out. So this was a candle that was responsible. So what we do is that we mark the candle. We had to draw a line, a horizontal line on the open of that candle, and we draw all the way to the horizontal. And now I'm going to go back to the 4-hour chart. And I'm going to zoom in. Now we've got it. It was around here. That candle was around here. That was responsible. It was around here. So what do we do? What do we wait for? We wait for a price to drop below that candle. And we have price dropping below all that candle. Because I showed you, if you go back to let's go back to the board. Let's go back to that whiteboard right here. Now you see these particular candle. Okay, we're talking about a selling opportunity right now. So I'm going to move here. Now, if you were hoping to sell here and you got taken out by this candle, and let's say this was the open of that candle. I'm going to try to make this V slow so that you can get it. Now, it means that at the open of this candle, while a lot of traders were, a lot of retail traders were actually selling, the dealers took those sales, the opposite side of those sales, and bought. They had an underwater position that they needed in order to clear all of these orders. Okay, not everybody can be selling at the same time. Yes, you are right. You've done all your analysis and the price is going to drop, but they need to take all the money first so they can push, pump that into the market and push the price down. Now, you've been able to identify that this was the open of the candle that took all that liquidity, okay? And price drops way below it. You've identified the candle right here, and we draw that line, and price drops below it. They have to come back because I told you that they had to buy to grab all that liquidity. So they have to come back and boom, hit that level again. Okay, this is not really touching it that much, but it's more like an example. So they have to come back and touch that level or go above it just a little bit so they can grab that their money, or they can mitigate on that position, that underwater buy entry that they used to clear liquidity. So they have to grab it. It's more like closing the door on that order or on that position, and then boom, they can drop price real fast to the other side. So now let's go back. I had to do this so you can see it before going back. Let's go back to the chart now. Now we have identified the candle right here that took out all that liquidity all the way up here, and price drops below it. And guess what? It moved back up. It moved back up and grabbed. Remember, we can't see the open of that candle right here, but this is the open because we moved all the way into the 15-minute time to grab the open of that candle that was responsible for these move to the upside. So we've actually been able now to get the open now on the 4-hour chart, because you don't want to be looking at that on the 15-minute time frame. You want to look at it from the 4-hour time frame. Now we have these guys going back up again in the market to grab or to mitigate on that. So it means that as soon as we have, let's go back to the 15-minute again. I'm gonna have to scroll even more. I should have used Trading View for this, but somehow I just like the MetaTrader 4 for some reason. So This is the candle right here. We are going to draw that line. I already did that. We draw that line and wait for price to drop way below it. As soon as price drops below it, I'm going back to the 4-hour time now. As soon as price dropped below it, it's right here. So if you can't see it, it's right here. Okay. So as soon as price drops way below it with this long candle, it moves really fast. It dropped way below. We mark that level. We take our crosshair and we check what a price level is that, and we place a sell stop right there. And what happens is the dealers are going to come back and mitigate on their open positions that they used to clear liquidity, like I said. So it means that you're going to have a sell stop somewhere here, okay, on that level. And guess what? Boom. You can see them again right here. This would have been an entry with just maybe 2 pips or 3 pips drawdown, a very low drawdown, okay? And see the move all the way down. Now, the beautiful thing about this is the levels where you expect the market to turn around becomes your target levels, okay? If you used to trade sensitivity levels, those sensitivity levels become your target levels. They become your take profit zones. That's what I'm talking about, okay? So instead of trading, waiting to buy at this level, you are going to be taking profit at these sensitive levels. So this is the opposite. This is how it is. It's a little bit different. So instead of waiting to trade at support and resistance levels become liquidity pools. And these pools become your take profit zones, okay? They don't become, you no longer trade, you no longer wait to trade double tops or double bottoms, or you don't wait to trade support or resistance. You take these levels as your profit zones or your take profit levels, okay? So this right here would be a take profit level or liquidity pool. It's not so strong, so it's not much of a liquidity pool, but you can use that as your take profit zone. So I'm going to clear this now. So if you entered, because they pushed it all the way up, boom, and then they returned and, you know, ran price all the way down. If you had your take profit right here, it would have been hit, and then boom, they were out of the market at this level. The dealers were out of the market at this level, and then price consolidated and rallied to the upside after that. So you can actually see how this works. This is the first example I want to give, and then I'm going to show you how to look at charts a whole lot different. And you are not going to trade. I had to take something off my table now. So you are not going to trade the popular style or the popular opinion out there. You're not going to trade these things. Instead, you are going to be looking for liquidity pools. Okay, liquidity pools are what you need. I say pools, that's what I mean. Liquidity pools, okay? It's going to be the game of finding liquidity, okay? Okay, if I'm not really writing this really well. But you're going to be looking for these levels, and the liquidity pools are very simple. They're levels of support and resistance. Very popular levels of support and resistance are the ones that you would consider as where all of the buy orders are waiting, or folks are looking to buy at these levels. So let me show you more examples, because I really want to keep this short and filled with examples, and because there are other future price levels that are supposed to be hit going forward, and I'm going to show you those. So let's clear this right away. And let's move back here. And I'm going to zoom out again because I want you to get the full picture. Remember that this was some resistance level. The market actually obeyed that level or respected that level, and it dropped, formed double bottoms here. And guess what? And guess what? Before actually dropping down, you can actually see all of these lines that I have. All the lines that I have will show you how the market moved from one place to another, from one level to another. Now you can see, let's start from here. Price dropped, okay, formed a low, which coincided with this particular low right here. That shows you something. It tells you in the future that we could see another move stopping there, which happened. But the question is, let's keep going forward. Let's see how the market reacts. The market comes back here, forms more like an M. It drops and then it goes back up. But before going down, a lot of folks would have been selling here because they expect price to. It's a very popular thing. If you look here, you can see that this level of sensitivity rallied, and it was the same right here. And you would expect to sell right here. But something happened. You can see that they all got broken by this one candle. I'm going to zoom in. By this one candle right here. One candle. And remember the rule, we're looking for the candle that breaks liquidity, or that grabs liquidity rather and breaks support or resistance. So looking for that candle, and you can see this one candle right here. And especially when you have wicks like this on the higher time frames, you want to get, for precise entries on the 4-hour chart, you want to get the exact candle that was responsible for that move to capture all that liquidity. So there was money sitting. Liquidity actually is money for the dealers. Okay, it is money. So I'm going to add something here. Let's see. Insert. Okay. This right here was money, and they cleared it. So when I put the X sign, it means that they have cleared this. They've taken it. There's nothing sitting here anymore. So a lot of stocks would have been sitting here. And I know you may be wondering, well, I don't put my stops there, but a lot of folks do. And you'd be surprised the number of people who do. And what happens? Boom, it cleared it. So the question is, what was the candle, or which particular candle was responsible for clearing that? So let's move to the lower time to check for that candle. This is the 1-hour time frame. And okay, here it is. Look at my X right here. So here it is. And another thing, I need you to write this down. When the dealers or the banks have cleared liquidity, there's a very you can actually pinpoint it with precision when you can find one candle going through, and then you can find an engulfing bar. Okay, so you can actually find one candle going through and an engulfing bar clearing liquidity on those areas. Then you can actually point with precision that this has actually happened. So you can actually see that I have a box. We call that an order block. It blocked these guys. It blocked these guys. And so they kind of, if you had your stops here, boom, you're out, you cleared out. And now you have a bearish engulfing bar totally covering a whole lot of these other candles right here. Okay? Now, you want to look at the candle that started the move, and this is the candle right here. It went up, closed above the level that we have, the resistance level, and guess what? After that, from here, we had another move to the upside. Okay? So this continued to move before the market went down. So whenever you see this in one chart, you really want to make that your focus. The candle and a bullish engulfing bar or a bearish engulfing bar. In this case, we're talking about a bearish engulfing bar. So you're going to be very happy looking at this without any of these forming yet. So you're going to mark the open of the first candle, which is here, the candle that started the move to clear out liquidity. You mark it and you do that, boom. And as soon as you do that, guess what happens? I'm going to insert another, something like an arrow. guess what? Price goes down and comes back up and touches it. They have to come back and mitigate. So your entry would have been here. Your entry would have been here, and it would have been a killer entry. Okay, it would have been a killer entry with about 1 pip in drawdown, and about, let's check how many pips that covered. How many more pips did it cover if you entered here all the way down here? 69, 80, 81 pips. And remember, okay, I'm going to talk about stops, and I'm going to talk about your take profit levels. I'm going to zoom out a little bit. Now, when you take trades like this, you want to make sure that your stops are just above these blocks, because the blocks, okay, let me go into more detail about those blocks. Now look at these blocks right here. Look at the block that we drew, because it starts from the open of the first candle that started to move to break these resistance and clear out all that liquidity. So that block that we draw starts from the open to the close of that candle. Okay, this right here is just a week, and boom, we had a bearish engulfing bar, and we drew our entry at the open of that candle, the first candle that started to move to clear out liquidity. And secondly, how this can be traded, you can actually also place a second entry at the 50% of the block, but I don't like to put it at the 50%. Okay, 50%, and at other times you can see price go all the way up to 50%, and touch that 50%, and your stops would be here, just above the block. Okay, sorry about that. Just above the block. Okay, to be precise, you might want to use your Fibonacci. Okay, to draw your Fibonacci, I'm going to draw it right now. Use the Fibonacci tool. Oh, come on, this is kind of crazy. Okay, let me zoom in even more. So your Fibonacci tool is what you use to determine your stops. And I use my eyes, but you can use your Fibonacci tool. The Fibonacci tool, let's start from here to the top. So much line, but if you zoom in even more, you'd be able to see where the Fibonacci lines up at 23 or 32. That would be your stop. Okay, I had to zoom in because this is really small. So you've got 100, which is the beginning of the candle, and you've got 50%. This would have been your second entry, and then you have all the way up to 22.6 or 23. That just above the block, that would be your stops. That would be your stop loss, rather. I'm going to take this out now. Yeah. So that would have been your stop. Now you've been able to identify that the dealers took a lot of folks out and they went back down. They're going to have to come back to clear, to take that money or to mitigate on that position that they used to clear this. So when you take that, your first entry would be at the open of the first candle that started to move to clear out liquidity. And your second entry would be 50% of the block. Okay? All right, because most times, sometimes, look, price sometimes will just come here, touch that entry, that open, and it won't go as much as far to touch the 50%. So that's why I trade more off the open, and then my stops just above here. And if you check, I'd be risking maybe a little bit. This is the 1 hour chart. Look, we're risking more like 7 pips. Okay, you can actually raise it all the way up, maybe like 10 to 15 pips, because I suggest I would most likely advise you to risk more, like 15 pips. This is 8, 15, just above here. But around 10 pips, you see, we don't get to risks too much because of how this trade lines up, the technical behind this trade, the technicality behind this trade, and as well as, as well as the precision. So if it goes above 50 and it just goes above this level, then it's false. Okay, you don't want to lose too much before coming out. You don't want to be in so much drawdown before coming out. 10 pips is enough for your stop loss, and it makes a whole lot of sense because it helps you to know that a trade is not going to line up, so you can move on and you don't just sit there waiting for it to hit 30 pips in drawdown before deciding to come out, or 50 pips, just 10 pips, because this is very precise. And as soon as it hits it, boom, it rejects and it starts to go down. And guess what? Your take profit levels would be areas of sensitivity. Sensitivity levels, price sensitivity levels. These are the week in, week out areas. Okay, in the past, if you check the left side, they're always close to support or resistance levels. These would be your take profit levels. So imagine if you took a trade and you entered this with very minimal drawdown and boom, 70 pips, or you would have taken as well as much as 97 pips. And see how fast it moved after taking, after they mitigated on their position, see how fast they moved to the downside. That tells you what these folks are doing. And this is how you can actually trade. I really want to move fast and show you some more examples. Now you have support here, but guess what? I always take the week, by the way. Guess what? They had all of this area taken out. This is a very popular level. They had it taken out. If you look at this at the 4-hour chart, you'd see it meets your W pattern. It meets that. Remember what I said, that you always want to see the candle that was responsible for taking out and clearing out all that liquidity. And on the 4-hour chart, we can actually see that candle. I'm going to zoom in even more, and you can see the candle right here that cleared all that liquidity. And as soon as that happened, guess what? We had a bullish engulfing bar. Remember on the last one we had a bearish engulfing bar, and I told you that it's a very sweet thing. If you see a zone like this, a sensitivity level just around support, and you see a candle coming to clear all that liquidity, because a lot of folks are going to be buying here, and they are correct. The price is going to go up, but it's not going to be that easy. The dealers want a lot of money out of the market first. When I say they need a lot of money out, they need to clear out a lot of orders, and they can use that money, put back in the market, and push the price in the original direction that they intended. So you can see the candle that clears liquidity, grabs liquidity, and then you can see a bullish engulfing bar. It's sweet. If you really want to mark the open of this candle that clears liquidity, and we have it here marked. Okay, I'm going to mark this as an X. They've taken the money in here. Okay, I'm just going to leave it. So they've taken all the money here, and boom, it goes back up. If you had, as soon as price goes above that level, we want to put a buy limit at that mark. You take your crosshair here and you mark that level. And if you have your pending order here, price comes back down, they mitigated on this. Look at the entry. The entry would have been very, very precise. very, very precise. And remember what I told you, that you don't want to risk so much. So basically your stops would have been around here, 10 pips, but this is 12, just around here. Okay, you're gonna have a stop around here. And your take profit, like I said earlier, would be at the levels where folks would be looking to buy or to sell. In this case, this was the closest. You know, we dealt with this, price dropped all the way from here, and now you're seeing another work, another manipulation from these guys. And now you can put your, if you are not so patient to hold trades for the longer term, you can actually put your profit level around here. That would have been how many pips? Let's check it out. It would have been 85 pips. Now we've got another level right here. Some other people are going to put that as their take profit zone, 136 pips. So you see that they pushed the price immediately. They mitigated on their position. It didn't cover as much as 1 pip, and then boom, it moved very fast. Cleared. Now it cleared this extra, went up and then came back down, and went back up all the way to this level. And guess what? We're not done. See how, let's just follow the move, how it went, and how at every point in time, they want to take folks out. As soon as they get to these very popular levels, now we talked about this all the way down, and they went back up, and boom, we know that the next target would be here. The next target would be here. So we want to look for these pools. These are, you really want to hunt these liquidity pools. And boom, they came back here. And you know, this was the first we dealt with. Okay, boom, they cleared all of that. You would have put your line, marked the particular candle that was responsible for clearing all that liquidity. And as soon as price went back up, boom, it covered it. Your take profit would have been around here. The last level, the first level of sensitivity. And look, price moved all the way back up. So that being said, it really exposes what really happens in the market. It exposes a lot of things that happens in the market. You can actually now look at it in a very different way. Okay, you can just say, I really want to see liquidity get taken out. We want to see the highs get taken out. And then I really want to look for the candle that was responsible for that. Now, especially when you see candles like this, they're like dojis and clearing liquidity on the 4-hour chart. Remember, we had to go back to look for the exact candle that was responsible for that. And look, we did. I'm going to extend the line. Good. Now, this is the candle right here. I'm going to take out all these drawings. Now, this is the candle right here. We've spotted the exact candle. And guess, on the 1-hour chart, they cleared out all that liquidity. And we are going to put a block on it. And then we had, okay, what block? I like to mark it. So guess what happens? We had, next up, we had a bearish engulfing bar. This is what you want to see. You want to see that. You want to see a candle clear out liquidity, and then you want to see a bullish or a bearish engulfing bar. It's very important. I actually missed one. There was one here. And look, after that, you go ahead and place, that line. And as soon as price drops below it with the bearish engulfing bar, you put a pending order, a sell limit, and guess what? The next candle goes into it. And look, very little, very low drawdown, and price dropped. So we know from this type of trading that if they come back to mitigate and price, and you have placed your pending order, and price just keeps going up all the way back up. You don't lose too much. You don't want to go all the way 15, 30 pips. You want to risk as much as little as 10 pips, 8 to 10 pips, just above your block. Because if it goes above the block, then it's not lining up, okay? And you're going to keep losing money. And you don't want to lose so much, because I like this trading style better, because even if I lose 3 trades or I lose 4 trades, the very first trade that I win gives me back all the money that I lost, okay? Okay, I've been using this and it's been fine. I'm going to show you some trades that I took. Now, look at this. Less than a pip drawdown. Less than a pip drawdown. And it first take profit would have been here. This is a level of sensitivity. That would have been 40 pip mark. The next would have been the 54 pip mark. And the next would have been 74 pip mark. And look how price drops real quick below all these levels. It would have hit all your levels. Because normally when price gets to these levels, right here, we expect that, okay, we're going to see some kind of reaction here. Okay, because we could see some rejection here, but that's not it, okay? When you trade this style, these levels are used as your profit levels, your profit zones, okay? Because they like to clear them. I'm going to mark them now. There's money below all these levels. There's money below all these levels. There's a reason why they like to clear them, go below or above them, okay? Because there's money or liquidity below these levels, so they like to clear them. So just know when you see, when you have seen a seller's profile, because that's what we call this, a seller's profile characterized by manipulation, mitigation. The next thing is they want to run all the liquidity levels. They really want to run all the lows. They're going to run them down. Take all the money behind below these levels, because a lot of orders are going to be lining up below. Folks are going to be thinking, well, the market could react here because it's a sensitive level, but they like to take all the money below these levels. So you don't want to use these levels as entries. You want to use them as exits. So I've been talking too long already, so I'm going to go and bring more, as much as possible, as much examples as possible. So there's another one here. This is the one I'll go to the 4-hour chart. On the 4-hour chart, let's zoom in. If you look at this level right here, where price looks like it is, sensitive right here, especially you really want to look at these weeks, okay? When 2 weeks are looking like they are on the same level and the market is respecting it, it's a trap, guys. It's a trap. And guess what happens? The next candle whipsaws, goes up, boom, comes back down, clears some folks out. So this is the 4-hour chart. So we don't get to see the candle. Let's check on the 1 hour. On the 1 hour, we get to see the candle that was responsible for that. Okay, we're going to use this candle right here on the 4-hour chart. Okay, it doesn't quite touch it on the 4-hour chart. Let's go back to the 1-hour chart to see. Okay, on the 1-hour chart, the question we should start asking is which candle was responsible for the move, okay? Because if we don't see which candle was responsible for the move that started the move, okay? And it's this candle right here. Okay, because I got it wrong. Because this is the candle that started the move. And then boom, price dropped continuously. And then guess what? We had a bullish engulfing bar just above it. And then you want to place your pending order. Price goes above, comes back down, touches it. Look, doesn't go. Look at that. This would have been an entry for a buy. with very minimal drawdown, 3 pips. And where's your take profit? The first take profit is here. Okay, like I said, levels of sensitivity, that would be 38 pips. The second here, 59 pips. Now they cleared it. So you'll be eating up and down, up and down, up and down. You just go with them. And they started the seller's profile from here. You'll be eating with them, up and down, up and down, up and down. As we go. Okay. Okay. In the next video, I'm going to show you something extra on how to, I'm going to go deep into the buying profile and the selling profile and how to catch some more trades with, especially during a trending condition. I'm going to go to the euro dollar, sorry, the gold, and take out this. And I'm going to show you how to do this on the shorter time frame. It's quite different because you have to base your analysis on the 4-hour chart. And only when you don't see the candles that take out liquidity do you go to a lower time frame to look for that exact candle. Here, I'm going to zoom out now. This is the 4-hour chart. Am I seeing correctly? Now I'm going to go to the 1-hour chart. Here you have one candle taking out these highs right here, and then a bearish engulfing bar. Actually, I don't know why this is looking like it's a gap, because when you go to the trading view platform, you're going to see a complete engulfing bar to the downside. And so you want to mark from the entry, you want to mark from the open rather of that candle that was responsible for taking out liquidity right here, and all the way up, all the way to the right. And you see the next, it took a long time. Price went all the way down, and it took a long time, you see, and hit it first of all here, went down, came back up, and it's still looking to drop some more. Dropped all the way down here. So that's the question. Where is it going to drop? All the way here? Maybe. So expect to see the move drop down here and back up, because they need to come back and fill all these levels. We've got some imbalance here. Some gap here. And you remember when I talked about, if you remember when I talked about the mirror trading strategy, we've got a very long candle here. Somehow price is going to drop all the way down, either to this level, because you want to use this as a target, as your take profit level, or drop all the way down there, drop all the way down there, and then the market is going to move back up. It has to move the same way violently to fill these levels. There's an imbalance around this area, and you remember, if you watched my video about mirror trading, price has to come back up, to this level. Okay, it has to come back up. And we could see that happening anytime soon. I'm going to move to some 2 more examples before closing for the day. 2 more examples. This is the pound dollar. Okay, you have the pound dollar here. I'm going to zoom in. Okay. If you check here, you find this is a high, okay? This is a high right here. So the question is, which candle was responsible for taking out the high? Which exact candle was responsible for taking out the high? So I'm going to zoom in. I can't find that candle because it happened so fast. Boom, took everybody out and then dropped. So where is that candle? I'm going to go to the lower time frame. I still can't find it. Now I can find it. Now remember, this is the level I'm talking about right here, the blue line, and this is the candle that takes it out. Followed by what? It's followed by a strong engulfing bar to the downside. We haven't seen price coming back here, so I'm going to draw my line. I'm going to draw it. I don't know when this is going to happen, but I'm just going to do it. If you can see on my screen that I already have a sell limit for that level. And look at my, okay, let me draw my block. I'm going to go ahead to draw the block. Now this is the block right here. So my first entry is going to be at the open of the candle. You already see that I have a sell limit pending order lining up at that level, just right there. And my stop is just, I'm going to try to measure up how many pips that is. Okay, 15 pips. 15 pips and minus $302. That's 15 pips. That's even high. So price comes back here and touches that. It drops all the way down. And so where's my take profit? My take profit is here. That's if it doesn't run these lows and clears it. So that's 2,700, about 2,700. So I really expect price to come back down, maybe after running these lows, because it's going to clear these particular lows here. Clear it, and I don't know if it's going to come down, but I expect price to come back here sometime in the future. And another one, the last example that I'm going to be talking about before closing. But before that, let me go back to the pound. I'm going to show you something, that this exact move right here, this rejection, or this particular manipulation right here, isn't just what you want to call a manipulation. It's because if you come back here, if you zoom in, you're going to find this, okay? You're going to find that. And if you draw, this was the start of something that took out this level right here. If you don't see it very well, you're going to have to go to the 1-hour chart to see that level, to see that bridge. Okay, see, look at this. Okay, this is some high. It's been taken out. So you have to move back and forth to see what was taken out. You need to see the support or the resistance level. Now that's what was taken out, and look at the candle that did that. But it started from here, and we want to see, like I said, we want to see the bearish engulfing bar, and now we see it right here. So boom, if you draw that, you see the price went back. This would have been an entry. It's really funny, right? This would have been an entry, boom, with a very short, very small drawdown, and all the way price coming back down. So I don't know if this is the second one, how it's going to turn out. I don't know how this is going to turn out, but I'm going to wait to see it hit. Okay, it's going to take a while. You have to be patient sometimes. So let's go to the, okay, I've got the Kiwi dollar. Okay, Kiwi dollar. Like I said, we're looking for areas of support or resistance. Right here, we have one. And if you're watching this video from here, I need you to go back to the very beginning where I said we want some rules, we want some criteria to be met. We want to see them taking out the highs, okay? Because a lot of pending orders would be lining up here, because this looks like a W. So a lot of pending orders will be lying at the top here, and some stops are going to be just above here. And look at the candle, it took it out, boom. And I zoom in a little bit. Now you have a bearish engulfing bar. So this meets all the criteria. You'd have had, this is going to be your block. All right, I'm going to draw this very well. This would have been the block right there. Hope I'm doing this right. Okay, your entry would have been at the open of this candle that was responsible for taking out liquidity. It cleared all of these, it cleared all of these, cleared all of the stops that were just lining there, cleared them out. So your entry would have been here, and look at what happened. Boom, it didn't take so much time. It took it out, and boom, it's going back down. If you check the 1 hour time frame, you're not going to see the engulfing bar, but you also get to see that candle taking out liquidity. You just want to move from one time frame to another where you want to see the candle take out liquidity, and you also want to see the bearish engulfing bar or the bullish engulfing bar, and then you can take mark the level. Okay, on the 1 hour chart, you can see this is the candle that started the move to take out liquidity. This is the candle. While on the 4 hour chart, you get to see the exact candle. And now, boom. I like this because it gives me very precise entries, and these entries are more like 90%. That's the reason why we have very little stops placed. We place our stops just somewhere here, and your take profit is just going to be around here, because this right here is a sensitive level, and a lot of since price gets to that level, a lot of traders are going to be looking, okay, we're going to see a reversal because the market could react to this level again, but it could just ride down below it. So that's going to be your profit zone. So this is how to trade this. I'm going to be releasing more videos and more. I can't put all of this in one video. This is as long as it can get for today. And I'm going to be releasing some updates on the group on trades that I'm going to be taking based on this. And you're going to have to be patient. Don't really think that because this is what I trade right now, and it's giving me some success, very good success. And I'm not willing to trade any other thing. Okay, precise entries, and you just go relax. All right, guys, that's going to be it for today. If you have any questions, just go ahead and ask me. I'm going to be having a live session real soon where I'm going to be taking some questions. But that's it for today, guys. I'm going to see you later, and there are going to be more updates on the group on these trades. I'm going to be making some trade calls based on this, but I need you to understand it first. So this is it for today. So you can go just check out where the market did this. Just go check it out. Go check it out. Okay, go study these things on your charts. I'm going to be coming back soon with another video. I'm going to see you then, guys. So take care.